So our first speaker this evening is, again, Howard Bowes. A good friend of mine. We go and play golf together. It looks like we're going off to Spain again soon. And please would you welcome Howard Bowes.
It's like deja vu, isn't it? But it is a completely different subject, fortunately. How many people here are investing in HMOs at the moment? Quick show of hands. Okay, so there's quite a few of us. How many people are investing in sort of standard buy-to-let properties? Okay, a couple of people there. How many people do title splits and developments, that type of thing? Yeah, a couple of people there as well. Okay, so I'm going to try and connect all of those different things to what I'm talking about, although the main theme this evening obviously is financing HMOs. And why do we talk about the finance, or more particularly what I'm going to talk about this evening is the refinance of HMOs. How do we refinance them and pull most or all of our cash back out of them? Well, the reason for that is most people who are here in this room want to grow their portfolios. That's why we're here. That's what we want to know about. How do we make more money out of property, whether that's flips or whether it's holding and getting income from those properties. And one of the biggest things that I heard in my capacity as a mortgage broker, of course I'm a property investor as well, but as a mortgage broker, was people saying, well, you just can't get enough money back out when you refinance. My money's stuck in for 6 months and I can't move on. And what's the problem? The problem is your cash is always stuck in your last deal, isn't it? And it's really difficult to move forwards and momentum invest if you can't find the money to do so. And one of the easiest ways to do it is to be able to refinance and recycle the cash that you've already got, your little pot of gold. In fact, it doesn't matter how big that pot of gold is, and it doesn't matter how many JV partners you could potentially do business with, eventually that's going to run out, isn't it? Would you agree with me that property is an expensive game? It's a rewarding game, but it's an expensive game. So that's what we're going to go through this evening. Just before I do, just to tell you a little bit more about myself, besides the fact that I play golf with Trevor. This property here is in Tenby, and this is five flats. It was always 5 flats. Well, at one point it would have been an old Victorian home, obviously. But when we bought it, it was 5 flats. It had been converted in about the 1970s, early 70s, maybe late 60s. And there's a terrible use of space. Now, there's got to be loads of properties like that around here, hasn't there? There's got to be loads of these. Been converted to flats, but terrible use of space. In this one, the basement flat, I've pinched that picture from the estate agent's brochure, it's not a good one. But there was a flat in the roof, 3 floors, and there's a basement flat as well. The basement flat was a 1-bedroom flat with a kitchen 17 feet long. Who lives in a 1-bedroom flat needs a 17-foot-long kitchen? So what we did there is we turned that. So actually, does anyone know John Guppy? I know a couple of people do. John, okay, so those who know John Guppy, this is a joint venture with John. So John's the guy who does the technical bit, I did the money bit and put the deal together, because that's the bit I like. So that's what we did here, and what we did is we turned the basement flat into a 3-bedroom flat. So from a 1-bedroom to a 3-bedroom. Do you think that adds value? Yes. Absolutely. What we also did then, the ground floor flat went from a 1-bed to a 2-bed, so did the next 2 floors, okay? All fitted en suites as well, so they all were 1 bathrooms, they're now 1 ensuite and 1 main bathroom. And in the top, which was a studio flat, just open space, without the expense of a dormer or anything else, a few extra velexes in there, but we created a 2-bedroom ensuite master bedroom flat in what was a studio. So again, adding massive value to it. And there's a reason why I'm pointing out that we added value to this property. It's going to be a theme through what I'm talking about today. We also split titles. Do you think that adds value? Yes. For those who are familiar? Exactly. So this building, I bought this building for £350,000. And that building with a £210,000 spend has been valued at £925,000. We finished it literally just before Christmas, and it's just now gone on the market. So the proof will be in the pudding. I accept that. We've got to sell it yet. But whatever happens, even if we take an offer, there's plenty of profit there. And that's because you created enough value. The strangest thing in the world, or 2 strange things about this property really, I think, is that when we bought it for $350,000, we got all of that profit margin for those who've worked it out, but actually we paid what that property was worth. It wasn't below market value. It was actually at its market value in its current condition. But it's just the way that we've added value that's increased that margin. And another thing that I would say to you is I actually sat down to talk to a couple of people about this deal when this deal started. And I said, I've got this deal here, but I'm too busy to do anything with it. They said, what are you on about? You need to go and get that deal. And they're your next speakers this evening. So thank you. So yeah, do you remember we were sat in the pub in Brighton?
Yeah, we just
exactly. Yeah. So, but there it is, and that's the property. So that's one of the ones I've done. This is another one that I've got now. This is a 10-bedroom HMO. So yes, I do HMOs as well. In fact, I'll do anything where there's money. So I love property. I'm in it for the game. I really enjoy what I do. And this one here, it was a doctor's surgery. After a doctor's surgery, it was converted into 3 flats, but they didn't comply with the planning permission, and they were being fined, and they had a sill charge they hadn't paid, and there was all sorts going on. So we sort of moved in, and we're cleaning up the mess and turning that into a 10-bed HMO. So that's what we're doing with that. Just gives you an idea of the sort of things I do. I'm also host of the Cardiff PIN meeting, a meeting just like this one, and of course I'm the managing director of Harvey mortgage and finance brokers. So just before I get into the sort of meat of this, I just wanted to put up a couple of risk warnings I'm required to do as a regulated broker. So obviously what I'm not doing now is giving any individual financial advice or finance advice. That would make sense, wouldn't it? Because we're a big group. Okay, I can do that on a one-to-one basis. But what I'm going to give to you is some experiences here and some case studies of what we've done. And the other age-old risk warning, it's a bit of a ridiculous statement because we all know it's true, but we have to inform you of that, and that's that your property is at risk if you do not keep up repayments on your mortgage. Okay. As experienced investors, I don't need to put that on the screen, but in case there's any first timers here, it makes me compliant. It means I put my FCA hat on and being a good boy. Okay. So let me move on. How to plan your refinancing, because that's what we're going to concentrate on. It's easy to work out the right way to buy a property, whether you're buying a bed and breakfast, you convert into a HMO, whether you're buying, in fact, a standard buy-to-let property that's a bit, run down and derelict. We're going to talk about not the way you get into that project, but the way you refinance it. And there's 2 things to look for right at the beginning of your process of buying that property, which is going to make it much easier to know whether you can refinance it or not. Okay. The first one of those is buying below market value, and the second is creating gain. Would you agree with me that buying below market value is more difficult now?
Yes.
Yeah? There's a lot more happening in the market. People around know the market is heated up. I went for a property today that went on the market on the 2nd of January, and it was already under offer. And these things are happening even in the quiet, sleepy parts of Wales, let alone in buoyant London. So yes, below market value is much harder, and that's why we really concentrate on creating gain. But there's another very important thing, and I do hear some property mentors and people, hopefully not within PIN, but we do hear of them saying that you can buy heavily below market value, you can refinance the property and pull all of your money out, and you know what? The lenders don't like it. They want to see some hurt from you as the investor, and that makes sense, doesn't it? But that hurt doesn't have to be cash. That hurt can be, in effect, your expertise. The fact that you've done a refurb, the fact that you've added value, yeah? The fact that you've put your own blood, sweat, tears, planning, and all of that into the property. So hurt doesn't necessarily mean money. What they want is your commitment in one way or another. And that's why creating gain is the key to being able to refinance and get your money back. 2 people you've got to get on side. Which one of those do you think is the more difficult? The surveyor. Yeah, definitely. The lender has got a set criteria, and as long as you can make the underwriter comfortable with what you're doing, and it's within their criteria that you're allowed to refinance and they can value it on open market value, they will do. Okay. And you have to position it right sometimes. There's a little bit of work that goes into that, but you should leave that up to a good broker. The surveyor is the person who is the most difficult to get on side. And why is that? Well, if they come in to see a property that you've just bought, and you bought it 4 months ago, let's say, and you want to refinance it now, and you bought it for 300,000, and now saying it's worth 450, the first thing the valuer does is looks on land reg, don't they? They look on land reg, and you paid 350 for that, or 300 for that. So they've got that information, it's available to them. And so the easiest thing for them to do is to take the route of least resistance and say you spent roughly 70 grand on this, so I'll now give you a value of 370. And that happens time and time and time again. And it can be painful when it does. So I'm going to go through a little system that we use now in a 25-minute presentation. I don't have time to go through it all. So I'm going to go through this fairly quickly, and it's part of what we do to ensure that you get the valuer on side, or do the best you can to get the valuer on side. It doesn't mean the valuer is going to do anything that they shouldn't be doing, it means that you're going to win over the valuer's confidence, that they understand what you're doing. Does that make sense? Yeah? So we're going to go through this now. Normally we put together a report for the valuer, okay? And I'm going to tell you what that report contains. So if you've refurbished a property, whether it's a HMO or a standard property, when the valuer comes, put a report together, we always advise our investors to put a costed schedule of works in, okay? If it's a HMO, it will always be a costed schedule of works. If it's a standard sort of buy-to-let refurb, you might get away with an uncosted schedule of works. And if you can, that's better. It is better to get away with an uncosted schedule of works. Who here is a member of LNPG? Yeah, so a couple of people, okay. So, you know, when you're buying your materials at below trade value, and you're buying them yourself, it's better that the valuer makes up his own mind how much money you've spent on that property. Does that make sense? If you're a proper investor, you shouldn't be buying this stuff at market value, okay? So all the materials and everything you do to regenerate the property, it should be at a much keener price than the retail or even the trade value of that. So if you can put an uncosted schedule of works in, it's better. But normally, certainly with HMOs, you are required to put in a costed schedule of works. So itemise what you've done and what that's cost. There's also before and after pictures. So always in your report put together the before and the after pictures of that property. Now I remember once somebody from the audience saying, why would you put after pictures in? Because they're there, they're valuing the property. You know, they can see it in the state it's in now. And I said, yeah, that's absolutely true, they can. So imagine that the valuer came to see your property at 11 o'clock this morning. What's he doing at 1:30, 3:30, 5:30? Valuing more, isn't it? Then perhaps the valuer goes to the pub, meets a couple of mates, goes back out the following day, does another 5 valuations and puts all his reports in at the end of Wednesday. Do you want him to remember yours the most? If you've done a good quality refurb, you certainly do, don't you? And that's why I would also put in after pictures. You're just positioning yourself as a professional. Also, realistic and recent comparisons. Now, comparisons can be difficult because, certainly with HMOs, what type of HMO, if it's already a HMO, what type of HMO is normally on the market? Is it a good one or a tired one? It's a tired one, isn't it? It's normally a retiring landlord and it's a tired property. So if you've got a freshly refurbed property, then you don't really want yours to be compared to something that's recently sold in your area, which has been in a rundown state, and that does happen. So you need to head that off at the pass, okay? So in your little report, if you find anything that was a HMO locally, and if you're investing, you should have that local knowledge to know what's around you. If you know that they're there, you should head it off in advance. Say, look, this property went for sale for this price, but it's worth less than mine for these reasons, okay? Get that in your little report. And at the same time, if you can find any HMOs that were of a higher value, then get that information as well. Home Track is a great place to get the information if you haven't got a sort of relationship with an estate agent that might give it to you. Okay. So Home Track is Home T-R-A-K. I can't remember if it's com or co.uk. It's a good place to go. Okay. Also, a RICS valuation report. Now, although you get an evaluation from the lender, we would always recommend that if you've done a full refurb and a substantial refurb, more so if you're doing things like title splits or HMO properties, that you get your own independent RICS valuation report done at the point it's refurbed before the lender's valuer comes. Now with commercial lenders, we can sometimes, particularly with the Cambridge and Counties as one of the banks, we can sometimes get a retype of that existing valuation, but we can never guarantee that. But it makes it much harder for a valuer to downvalue your property if you've already got one of his colleagues, you know, somebody from the Chartered Institute of Surveyors, who's valued the property at the level that you're expecting and recently. So I would always do that. It's a little bit extra cost, but I think it's worthwhile. I would certainly always do it myself. HMO license. So if it's a HMO, make sure you've got your license in. In some areas, they will allow you to start tenanting properties before the license, as long as you've applied for the license before the license is granted. So in that case, you just provide proof that you've applied for the license. Always better to have the license in play. Okay. And then we've also got copies of all your tenancy agreements. Now, if you want your property valued on its income, as opposed to its bricks and mortar value, and that's great in some areas of the country where you've got real high yielding properties, then really the best way to prove what income you can get from that property is by proving there's people in there paying. That makes sense, doesn't it? Yeah. So always have the tenancy agreements. It's best to refinance a property when it's fully let, at least 75% now. And also your strength of covenant. So substantiate your strength of covenant. Now that's a complicated statement for many, so even for seasoned investors. So the easiest way to break that down is to say that imagine that you've got a shop. Now let's move it away from HMOs. Imagine you've got a shop, you're renting your shop out. Now if you rented that shop to Andy's Fish and Chips, or you rented it to Costa Coffee, which one is a more powerful contract? Costa Coffee, exactly. So that's the strength of covenant. Okay. So strength of covenant is a rigged term, but what it really means is what's the validity of your contract, of your tenant. Okay. Now I've applied that in the extreme so that we can understand it. But let's say, for example, you've got LHA tenants. Okay. Then you could say the strength of your tenancy is pretty weak, isn't it? The strength of your covenant is pretty weak because they're LHA tenants. However, how can you turn that around to being a positive? How are you getting paid? You're getting paid direct. You're doing one of these schemes, yeah? So how are you getting paid? How are you protecting yourself? How are you then strengthening that covenant? Does that make sense? Yeah? So you put that information in play, and that will help the valuer to understand what you've done, that you're more professional, and also hopefully reach the sort of valuations that you're expecting. I'd also say that you need to make sure the valuer has access to all rooms. How many times I've heard valuers say to me over the phone when we're trying to argue about a valuation when things haven't gone right, and they say to me, yeah, but I couldn't get in room 6 or 7. And the valuer is supposed to go into every single room, every single lettable room for definite, okay? So if they can't, because you haven't arranged those tenants, or you haven't brought the key with you as the landlord, and all of that means that you're asking the valuer to compromise on his decision as to what he's going to do. He's either going to not go in and give you a valuation, or he's going to reappoint to come back. You're only paying him once, does he want to come back? No. No. So make sure they have access to all rooms, and that will get you a much better position. So what we do is we put together this report, and we generally recommend that you give that report to the valuer. Now, some valuers are quite receptive, some valuers are quite dismissive, so the best way to do it, I've always found, is just to say, this is my research, I hope you find it useful. And just let them take that information from you. Okay. And a clear business plan as well. So always have a clear business plan. That just needs to be 3 paragraphs, really. This is my experience, this is what I've done with this property, and this is what I'm going to do when I release the money. And obviously that doesn't mean you're going to go down to the casino with Trevor. That means that you're going to reinvest that money into property. Okay. So just quickly, if it's a commercial proposition, you're more likely to get a commercial valuation. And here's some key points. If it's all ensuite rooms, that makes it more commercial than residential, isn't it? If all the rooms, if it's got kitchenettes in the rooms, that's obviously going to make it more commercial, isn't it? And if you've got licensing or Article 4 areas, that makes it more commercial. And the tenants again. You need to establish tenant demand to your valuer as well. Because if the tenant says, if you've got great yielding properties, I'm looking at a couple of people now saying, you've got great yielding properties, you've got really good contracts, but actually the valuer thinks the market value is lower, then they're going to say, yeah, but if you lost those tenants, you can have those tenants over there, and so it's worth less, aren't they? Yeah, do you see what I mean? So you need to establish the demand at the level that you're getting as well. If you can do that with lots of online research. Also the type and length of lease makes a difference. So if you've got a 5 or a 10-year lease on a property to a charity or a limited company or something along those lines, that's more valuable than an 8-bed HMO having 8 separate 6-month ASTs. And that should make sense as well. And also, as we said, it comes back then to the strength of covenant. Let me talk very quickly about a value based on income. So, have you heard about this, about getting HMOs valued on their income? Okay, there's lots of myths in this, so I'm just going to bust a couple of myths for you now. So, that value is normally capped at 130% of the bricks and mortar value, and I'm going to illustrate that to you. So, let's say, for example, in areas like South Wales, Norfolk, Hull, you can buy a property that's really high yielding. So you might pay £100,000 for a property, but actually you can get £18,000 or £20,000 a year gross income from it, or even more in some instances. Now, this idea that that property then is worth 10 times its income, so if you're getting 20 grand a year, it's worth 200 grand, is ridiculous, okay? And no valuer is going to value it that way. And if you try to value it that way, and you put 200 grand in on your request, when the valuer sees it, he's going to think you're taking a mick, and he's just going to give you literally a bricks and mortar val and no consideration to the income. You've got to try to be realistic. So what we find is in those places, even if it's yielding really high, if its normal value as bricks and mortars 100k, then even if technically it should be worth 200 by its income, they'll cap that income at 130 grand. Yeah, 130%. Okay, so 30% uplift on its bricks and mortar. That creates their safety zone, because if you do the maths, it means that 70% loan on that means that there's a little bit of equity left in the property. And that's the point. They'll normally cap the loan at 90% of its true bricks and mortar value. So in that illustration, 90 grand. I don't know why I've got that slide twice, but there we go. So let's say, for example, we've got a property at 250k, to give you an example, okay? And the rental income is 50 grand a year. I'm actually using a real example here of a property in Bournemouth. I just use this one for the figures. If you had 10 times income, fantastic, it's worth 500 grand. It's just not realistic, is it? It's not going to happen. So what would happen here is they give you that 130%. So if it was a licensed HMO, so it was a C4 classification, a commercial building, you get realistically a value of 325 on that building. Okay? And that's a much more realistic position to place it. So always talk to your mortgage broker about this. If you're using a mortgage broker that understands commercial property and understands HMOs, they should be able to work out the commercial value on paper there or thereabouts without even seeing the property based on the area, the income, etc. I have many conversations about that. And that would of course mean the loan would be 227,500 in that instance. Yeah? So 325 and they lend 227 against it. What that does is it still provides a little bit of equity in there for the lender in case anything goes wrong with the deal as far as they're concerned. Yeah? So it puts them within their safety zone. Now if you are buying at a key market value or you're adding value to the property, then really that shouldn't be a problem, should it? Because you should have added enough value to get all your money back under those circumstances. Would you agree? Yeah? Okay. So this is the formula that we use at Harvey. Anyone know these two? Yeah? Okay. They're your next speakers this evening. I'm just going to go through, this is one of their properties, and obviously they did a substantial refurb, as you can see from those pictures. It's the figures that are important. So the purchase cost of this was 225,000. The refurbishment was 120,000 pounds, so that's what they spent refurbishing the property. So the cash that they needed to buy and refurb this property is 175,000. Okay, that was the cash input. I have got permission to do this, by the way. It's not a shock to them. just to let you know. The gross annual income of that property was £50,800. What we achieved was a multiplier of 9.35. Okay, so that was the income multiplier that was used. The gross around 58,800 times by 9.35 will give you 475,000. It was valued at that, and how much cash back came out? About £6,000 cash back, let alone having all your money back. Who likes the idea of cash back when you refinance? Yeah, I thought you would. So, you know, a fantastic deal and a real example of one that's happened very recently, just to show that these things happen. Return on investment when you've got no money left in is infinite. Exactly. What a great deal. What a great deal. Do you know this guy? I was going to show you one of mine as well, but I'm kind of running out of time because I waffle too much. What I am going to show you here is the multiplier that I got on mine was 8.5. Okay, because the area wasn't as good. So again, your broker should be able to help you with what type of multiplier you would get for what type of area, how they're going to calculate the income, and that's based on the anticipated yield in that area and the market value in that area, etc. So obviously I invest in South Wales, and the market value in South Wales is obviously weak compared to other parts of the country. So, but anyway, it was a property that I bought for £60,000. I spent a load of money on it, but I did get £12,000 cash back at 153,000. So, well, okay, 11,882 for £100-something. So that just gives you an idea of a couple of deals that we have done. So it is definitely possible to refinance a HMO and pull all of your money back and some. I think it's very optimistic to say that you're going to pull out cash back. There aren't many cashback examples I could give you. There's plenty of examples where they kind of wipe themselves clean and allow you to move on to the next project. What guarantees they will get you commercial value? Unfortunately, there are none. But what I would say is use the formula that I've shown you. You know, if you use Harvey Bowes as a broker, we will help you to do that. And don't take shortcuts on that. Just do it properly. Take your time on the research. Get it all done correctly up front, and you should get a much better experience. Because I've abbreviated this talk down significantly this evening to do it within a sort of 25-minute slot. There's some points that I would love to have covered that I haven't. If you go on to hbapply.co.uk and pop in your details, it's entirely up to you if you want to do that. You're not going to get bombarded with database information from us, okay, because you belong to the PIN database, not Harvey Bowes. But what we will do is send you that information, okay? So information on the best lenders for HMOs and some other bits and pieces that you might find useful as an information pack. We'll also do a free portfolio review for anyone that's looking for that. So that just brings me on to say, yet again, for the second time this evening, thank you very much for listening to me. I hope you find it useful, and my contact details are coming up on screen. Thank you.
Excellent. So, and it really does happen. I'm actually doing some business with Howard. We're buying some, well, 8 properties to start with, and the second one we've agreed as well. And the first one is buying, and we will have no money left in, and making a monthly profit.
Significant monthly profit, I would say.
Yeah, so that's quite a nice way to build a big portfolio. Thank you very much. If you just show your appreciation again for Very good.